The challenge is that risk management is a dynamic discipline, so you always need to be adapting to the environment you're in and ensuring that you maintain a positive and constructive influence in your organisation and don't rest on any particular standardised approaches, be they your governance practices or the brilliance of your people. All of those needs to be maintained.
The biggest challenge in the risk management industry in the next 5 years is, I think, to make sure that people keep talking to each other. Risk is obviously about measuring things, about understanding where your risks are coming from, about getting data, but you can't underestimate how important it is for people to just talk to each other, to share information, to get different perspectives. And when you look at things from a different angle, you can often see a risk that you've not seen before. So I think it's about communication.
For me, it's still to comply with the regulatory challenges, especially as they now are diverging and at a degree I've never experienced before. So each and every country is more and more establishing its own standards. For example, in Germany, the qualitative advanced pillar 2, the MA risk, is now, because Solvency II as such is delayed, this MA risk will now be converted into the German insurance law. It is proposed to do this by 1/1/14. And that's definitely different from the final outcome Solvency II might have. So each and every country is doing its own route.
The biggest challenge in the minute, I guess, is there are a lot of pressures outside, be it regulatory pressures, being a lot of other pressures, but keep in mind what are the economic important value added that the industry can bring, raise this awareness to the policymakers, for example on long-term investment, which is kind of underestimated the importance of the industry, and at the same time we're looking at risks which we probably are not aware because they are slow-moving. So slow-moving risks and the importance of the sector of long-term investment, I think, are some of the two key issues.
Quite simply, creating value. That we've been in a phase over the last 4 or 5 years of build. It's around efficiency and value.
Once you come up with the plan, it's actually implementing that plan within your organization and doing it in a way that it's adopted and successful.
Low interest rate environment, and as a consequence, what is the target operating model for a life insurance company?
Well, I think, if I may, there are several, if I may just highlight. I think the first one is there's quite a lot of uncertainty in terms of the regulation. There's EIOPA, particularly around Solvency II, the delay, exactly what they mean by risk management cultures, what they require. There's a second layer about what the local regulators will actually want, firms within their regions to implement. So I think that's one aspect. I think the other side of the coin is how do you actually use the risk management programs and cultures to drive out business benefits? And that really drops down to the relationship between capital and risk. So how do you understand better the relationship between capital and risk in your business? That means defining new measures, possibly implementing new tools to actually generate out that useful data you need for business decision making. Then of course you've got to store it and make it available to the business. And that leads on really to a final point, which is around if you're looking at risk management and risk cultures, particularly in relation to Solvency II and some of the other regulations like IFRS coming along, it's a lot dependent on risk and analytical data. So there's a whole raft of data requirements, data management requirements. So underpinning that risk culture as well as the processes and the communications is that whole data piece, which I think is very important.
I think the biggest challenge in the risk management industry today is to get the appropriate level of buy-in from the various stakeholders that the risk management industry has to work with on a daily basis. That's really the only way that risk managers can achieve what they're setting out to achieve.
Building resilience to unexpected events and things happening in the markets or in the business.
I think it's this complexity and increasing interconnection of risks, increasing regulatory burden, managing different stakeholders that sometimes have very contradictory objectives, shareholders, regulators, rating agencies, but also customers.
One of the biggest challenges, like I mentioned this morning in my opening comments, was the fact that with an insurance company, risk has been split historically from the actuarial side and the traditional actuarial modeling, and the asset side where the asset managers and risk managers typically work. And traditionally there's been no bridge between the two. So the big challenge for these insurance companies is to pull together the assets and the liabilities and put it in a coherent framework where the management at the top of the house can get all the metrics they need. For example, risk, capital, profitability, and then have a central spot where they can then perform the multitude of different types of stress tests that, that they need to run in order to manage the risk and profitability of the organization, and of course also to satisfy the regulators.